All right, welcome back to season 2 of the Bootcamp. This is episode 5, and today we're talking about premium and discount ranges. So premium and discount is a theory that relates back to that kind of auction theory of the market that we've discussed. And it's really useful for avoiding bad trades from bad zones and also taking really good trades from good zones, right? And it's going to give you primarily loads of clarity around the market and as to what's actually happening behind the candles. So we're going to look at what premium and discount theory is, why you need to know the differences, and how to use this premium discount theory to actually catch great trades and avoid the bad ones too. So with that, let's get into the class. In this class, we're going to talk about the different ways to determine premium and discount ranges, as well as what they actually are and the theory behind premium and discount, okay? So you've probably heard premium and discount talked about loosely before, and if you watch the bootcamp, you've probably heard me elaborate upon what you might have heard in the past quite a lot. Now, premium and discount simply refers to kind of price ranges, right? And the deal that someone in the market is getting for purchasing or selling an asset. Now, as traders, if we boil it down, because what too many people do in trading is they focus too much on charts and they don't think about what is happening behind the charts. A lot of people don't even think about trading as trading. They just think it's these magic candles that make you money, okay? Realistically, what a chart is when we look at this is the market presenting to us what is happening in terms of buying and selling, okay? When we get big movements up, this means there is a lot of buying taking place and lots of people want to buy. So therefore, sellers or people that hold the asset can demand higher prices, right? When the market is declining, it's the opposite. People are holding this asset, they want to sell it, but buyers are demanding lower prices in order to buy. So this would be a discount price, for example, down here, and this would be a premium price, okay? If you bought up here, you bought at a premium. If you sold up here, you sold at a premium. But if you bought down here, you bought at a discount. And if you sell down here, you unfortunately for you have to sell at a discount too, okay? So that is what premium and discount is all about. It's about where the market is and whether traders are buying or selling at premium prices or discounted prices. Now, drawing it back to our examples that we have here, in an uptrend like this, there are buyers at every step of the way, okay? Now, obviously, for transactions to take place, there has to be buyers, there has to be sellers, but there doesn't necessarily have to be buyers or sellers at every single tick price difference in the market. So if you wanted to buy here, for example, but all of the liquidity at this level has been bought up, and the next person offering to sell to you is offering at this price, well, that's actually what creates market movements. That's what makes markets go up, okay? Because what's happened is you tried to buy here, but you had to buy this level. And then the candle goes up to fill the gap between where the previous transaction happened and where the current transaction happened. Now, if you've bought here and someone else wants to buy, well, there may not be sellers at this level willing to let it go. So they may charge this price. And that is why the candle will then move up again. And this is what happens all the way through upward moves in price. Now, eventually, when we start to reach a level where demand is a little bit lower, so here, for example, if you wanted to buy this asset, if you are holding this asset and you want to sell it, but suddenly demand is a little bit lower because all of the buyers have already gotten themselves in, well, you may have to offer this price or this price and sell it for a little bit less than the price was just a moment ago, because there aren't buyers willing to pay this price, but there are buyers willing to pay those two prices, okay? So that is why charts move. It's literally just visualization of where the orders are happening at which price level, right? So if you are trying to buy, you always want to buy realistically at a discount. It's like everything. If you can get the same thing for cheaper, why would you not do it? Okay, if it's just as easy to get, then why would you not pay a discount over a premium? If you're trying to sell, then you want to sell at a premium. This goes for both sides of the situation, okay? So if you're holding this asset, say, and we get up here, you'd like to sell this for the highest premium possible. Because if you bought it down here, well, the more you can sell it for, the more money you're going to get back, which means the more profit you've made. And if you're not holding the asset and you want to short sell it, meaning you want to profit from a downward move, well, the higher you sell, the more room for movement you've got on the downside, meaning the more potential profit you can make if the market goes in your desired direction. So buyers always want to buy at a discount and sellers always want to sell at a premium. Now, there are a few ways that we can work out whether price is in a discount or a premium. We're going to go through each of those. They include supply and demand. But the first thing we're going to look at is going to be Fibonacci. So if you go to your trading tools and choose the fib retracement tool. You're going to plot this on and you're going to get rid of everything except for the 50% line, okay? So I'm going to put a background on it just to keep it simple. We're going to put the 0 level on and we'll put the 100 level on. Basically what this is doing here is showing the discount and the premium, okay? So we have a 50% mark marked on. And what this does is allows us to run this across price, and it's going to determine whether we're in the top half or the bottom half of a price move. So if we do this, then we draw from the bottom to the top in an upward move. We've got our premium and discount ranges pretty much automatically placed onto this chart. So anywhere above the 50% mark is going to be seen as a premium price because we are trading higher than halfway in the current leg of movement. Anywhere beneath the 50% mark is going to be seen as a discount price because at this point, you've got a 50% or more discount on the asset from where it is trading as of right now, okay? So if we come down under the 50% mark, this is the point where we should be interested in buying an asset if that's what we're looking to do, because that's seen as the discount range. Premium-wise, if we buy up here above the 50% retracement, then we're buying in a premium. Essentially, we are, to a degree, overpaying for the asset. Now, this is not great because obviously, if we buy in a premium, there's more likelihood we do move down into a discount. And then if you've bought in here, you're having to withstand some drawdown. And also, if you buy in a premium, you have less movement for profit, right? Because if the market gets back up here, you might make a clean, 3%. Whereas if you bought it from the discount, you might make 7 or 8% because you've got so much more room to move and so many more multiples before you close your trade, okay? So buying above the 50% mark in premium territory is not ideal. We don't want to do that. Buying underneath the 50% mark in discount territory, anywhere between the 100% and 50% retracement, that's good. That's what we want to see. Now for a selling movement, this goes the opposite way. Pretty simple, but what we do is we get our retracement tool, we run the top to the bottom of the move, and now from where we are, we can see the 50% retracement or pullback, the 100% retracement or pullback, and then the 0% retracement or pullback, which is of course where price currently is. So in this situation, we basically keep the discount and premium the same. However, we're looking at selling opportunities because we're trading down. So what we want to do in this case is sell at a premium. As we said before, the higher the premium we can sell at, number one, the more profit you'll secure if you're closing buys. Number two, the more profit potential you have if you're opening short sells. If you can sell from this high, then you get all of this additional ground before we even move back into the discounted price, okay? So you never want to sell at a discount. It's not great. Obviously, as humans, if we are selling something, we want the biggest premium we can get for it. If we're buying something, we want the biggest discount we can get for it. It's just self-serving attitude of humans, I guess. And if we take a look at this in the markets, this is exactly what everyone's doing, right? You don't want to sell at a discount, you want to sell at a premium. But you don't want to buy at a premium, you want to sell at a discount, okay? So in a selling situation, we don't really want to sell the asset underneath the 50% retracement. This means we are essentially in the higher boundary or the lower price boundary to sell at, okay? But if we cross that 50%, well, now we're getting 50% or more premium on our price, right? So if we have sold down here, for example, you're only going to get a small amount of profit potential. But if you sell all the way up here, you almost double the amount of room there is to move, which doubles your profit potential. So obviously selling in a premium and buying in a discount is what everyone really wants to do. Now, the reason it's so important to understand this is, well, first of all, we can utilize this information to get ourselves buying in discounts and selling in premiums. But second of all, because this is how the market moves and this is the flow that pretty much all market participants follow, we can utilize this information to find where's going to be good and where's going to be bad to buy or sell from, okay? So for now, if we just factor in the Fibonacci, which is really going to be the core focus of today's class, we can take a look at this upward move and we can see that inside of it, there's a demand zone here and there is also a demand zone above just here. Right? So we've got two zones to potentially choose from on our buying journey. If we want to buy this asset, there's this point and there's this point. Now, the premium and discount theory here that I'm teaching you makes this a lot easier, selecting between these two zones, because we can see that one of them is in the premium price range and the other is in the discount. Now, as we know, traders, including us, would prefer to buy at a discount. So buying in the premium just makes little sense. Now, if we don't see reason to buy in the premium, why would traders with $10, $50, $100 million ready to allocate into an asset, why would they want to pay a premium for it when they could just let the market naturally flow down towards a discounted price range? Now, because markets are driven by transactions, if no huge transactions on the buy side take place up here, then demand will just simply dwindle and the price will decline as people naturally sell out, right? So people sell out of the market as there's less interest. It happens in pretty much everything. Think crypto. When crypto starts declining, interest slows down, people get worried, and therefore the price drops as they're all selling and they're willing to take a lower price for the asset they're selling. So that's what happens here in currencies and in commodities and everything else, every financial market in the world. If there's no huge bullish transacting taking place up here, the people holding will simply slowly sell things off and the market will naturally breeze down towards what is seen as a discounted price range. Then the market will start to pick up when the large transacting takes place. And one of the core points for that to happen from is going to be a demand zone inside of a discount price range. Now, if we think about what a demand zone is at its core, to run through this now, a demand zone is simply, in its own right, just a type of discount price area. So within every price movement, the demand zone is basically the low point before the impulse to the upside. So within this given context, this is going to be the most discounted point in the range, right? Why? Because, well, every price preceding or following on from the demand zone is higher than the demand zone itself. This is why demand zones and supply zones work, because they basically show where the price was when people saw this as a discount or a premium to buy or sell from. So in a buying example, when we see a discount or a demand zone, that basically tells us that this price range before the impulse was seen as a discount or a fair price to pay for this asset. Therefore, we got a rally. Now, because we know it is seen as a discount by market participants, we should then expect that if the market returns to it, we're going to see that new influx of buying from a discount taking us to new heights, because these traders who wanted to get in here, here, and here, but didn't, have allowed the market to naturally flow down to a point they're now happy to place those big orders at. That's what creates the impulse, and that is what really drives the trends. So demand zones and supply zones in their own right are discount and premium ranges inside of individual isolated legs of movement. But when we can layer on the discount and premium Fibonacci to see that 50% mark, then we get a deeper picture, because even if we have multiple zones inside of a leg of movement, we can see which ones are the most discount, right? It's that simple. If this zone is at a better discount price than the one above, which is in a premium price, well, now we zoom out, take interest off this one and put it on this one. And simply because the big transacting isn't happening up here, well, then there won't be enough volume or fuel to drive the market higher. The market will slowly and naturally bleed down until it hits a point where significant buyer intent steps into the market and drives us higher. So that is how it works on the buy side. Now for a sell side example, it's pretty much exactly the same. Premium still at the top, discount still at the bottom, but this time we've got supply zones. Okay, we've got a supply zone that we want to sell from here. We've got a supply zone we want to sell from here. Except one of these supply zones is in discounted price. We don't want to sell in a discount. Neither does anyone else, especially not large participants like corporate banks, trading firms, and people with bigger brains than us. So if they're not going to be selling in a discount, they want to sell at a premium, then we should look to do the same. And by using that 50% rule, that Fibonacci rule, we see that it's better to avoid any zones that are in discount price if we are looking to sell. So you don't want to sell in a discount, you want to sell in a premium. And then if you're buying, you don't want to buy in the premium, you want to buy in the discount. All right. So translating that over to the candles, we're taking a look at a selling movement down from here to here. This is quite a clear downward movement, and we would ideally want to sell into this, okay? Now, what I want you to do is think about this as transactions instead of candles, right? We know there is selling intent at every point of this journey, and we know that basically people want to continue selling this market given the structure. But if you wanted to sell this market, would you sell it from this price, or would you rather sell it from this price here, or this price up here? See, each of these supply zones individually represents a premium price on its own given right, okay? This is the most premium price of this leg of movement. This is the most premium price of this push of movement. And this is the most premium price of this leg of movement. However, when we factor this into one individual movement, which realistically it is, it's just an averaged out run down, we see that, of course, some of these are significantly more premium than others. So we're going to grab our Fibonacci retracement. We're going to stick it from the top, nice and precise, to the bottom. And now we've got our premium and discount ranges. Okay, discount is always the lower range, the lower price. Premium is always the higher range, the higher price. So we got discount down there. We got premium up here, all right? Now, when we take a look at these three supply zones, well, we can see that this one is absolutely in the middle of the discount a little bit further than halfway down the discounted price. So this just simply isn't a good price to be selling the asset at. The other one is sitting right on the boundary of the discount and premium range. So again, not really ideal when we have this clear premium price zone open, okay? Now this one could be considered if we were to see the right structural shifts coming from it, but this one, absolutely no-go. Now, what we're doing then, when I say think about this as transactions, is just simply put yourself in the mind of an institutional trader who wants to sell off US dollars against the Japanese yen. So let's say you're looking to do a trade with another commercial bank and you're going to sell them US dollars. They want to buy US dollars from you. Where are we going to do that? Well, we want to do that at the most premium price possible, okay? So what you're going to do is just not inject any significant selling pressure into the market, because without significant selling pressure, we can't get significant downward movements. And that may mean that transacting will slowly kind of work with itself to the direction that you want it to go. So throughout this move, we had clear selling control. And then at this point, sellers got a bit exhausted. Some buying pressure came back into the market, and we started to reach a more premium price where we took control from the sellers again, where the sellers take control and we see that domination coming back in. Now, as you see throughout the movement, we start to slow down. Every movement is a little bit slower than the last. This one, strong and fast. This one, a little bit choppy, pretty strong though. And then when we reach here, we start to see kind of an equilibrium. What's happening here is sellers who are in these movements are taking profits down here, and new sellers are not happy to step in given that price is at a discounted level. They want to sell from a more fair and premium price, so they will await the market to return higher before they sell. That's why the market goes sideways, because in here, we're just not seeing the volume of short orders being opened that we were seeing at these higher prices. It's just like if you wanted to sell something to someone, but the market declined a little. Let's say you had a trading card and it was worth $3,000 last week, but now because so many people have been selling them and kind of undercutting each other with the price, we're starting to see less people willing to sell them at these lower prices, right? All of the supply has been taken up. So those trading cards have been sold already, and the people that still have them want to hold on to them because they're not happy to sell them at this price given the supply shock that has entered, right? If all of an asset is bought up or the majority is bought up, well then you can actually demand higher prices to sell that asset. So if we see the supply being taken up on this way down, so we see injection of supply, but at this point the people holding supply don't want to sell, well then we're not going to see more significant downward moves because they're not happy to sell it down here. So the market will have to return to that more fair pricing where sellers are happy to sell again. When we get up there, we're going to start to see less people wanting to buy because the price is higher, and we're going to see more people pushing in those big sells because they're getting the premium they want. So that's what flips the battle again. Here we see buyers saying, okay, I'll pay this for the asset, but we start to reach a point where it's just not going to be happening in massive numbers anymore. So it's that battle shifting the other way. Buyers don't really want to buy in mass up here, and sellers really want to sell in mass up here because we're in such a premium price range. Then eventually we see supply falling into the market from a higher price, and that's what creates the big drives down that we see, because now we have lots of people selling and less people willing to buy, okay? So it's really all just a battle. It's just someone has an asset, someone else wants it, and it's all about trying to find that fair middle point in price between the two. When supply is being dumped into a market, lower prices are going to come naturally. When supply is dumped into a market so much that prices get so low, people holding remaining supply may not want to sell, and buyers will have to pay more in order to get that asset. When the market reaches too high of a point, too high of a premium, then the buyers here get burned because suddenly sellers start selling off at a premium in force again. And that big push down in the market creates a lot of supply injected into the market. Buyers aren't happy to pay this much. Sellers then are already selling so heavily that buyers are demanding lower prices, and the cycle just repeats over and over again. Okay, so it's just a game of cat and mouse between buyers and sellers. Sellers are happy up here, they're not so happy down here. Buyers come and meet them in the middle, they're not so happy buying up here. Sellers are happy to sell up here, and then it comes down, then it comes back, and so on and so on and so on. That's what we see in the markets, all right? So that is what we've seen in this example. We saw the 50% mark was cleaned out completely. We traded through the discount range, almost all the way through the premium range. And when we reached the most premium possible price, we got the selling movement from there, which drove us to new lows, okay? So that's how it works. And of course, if you're looking at it from the perspective of how do we trade this, well, you use this 50% mark as your premium discount range to determine any zones beneath there are suboptimal for selling. Any zones around that point are Not ideal, but with the right confirmation could be considered. And then if you're going to be placing orders, direct orders to get yourself into the market, well, the most premium range is the point you'd want to do that from. Because if we get up here, buyers are going to start to slow down and selling will come in force, which should lead you into a profitable downward move. So note, if you didn't know this and you sold here, you'd have been destroyed. If you didn't know this and you sold here, you'd been destroyed. Now that you do know this and you sell here, well, then you make a massive profit. You have a much more considerable risk reward, a much bigger range to trade through, and you're just ultimately getting the best possible entry with the highest probability of success. Okay, now let's flip it and explain this from the other side. So we've had a downward movement, which has recently shifted into a bullish movement up. The reason this has taken place, we've seen buyer intent coming in from this level. Throughout this, we're seeing buyers and sellers transact, but buyers are more willing to buy at higher prices and sellers are less willing to sell at lower prices. So we see sellers offering at higher pricing and buyers taking that, which is why we have these upward movements. All that the upward candles show us in reality is transactions taking place at higher levels because sellers are only willing to sell at higher prices and buyers are willingly taking those orders, okay? Now, eventually buyers will stop taking those higher orders. They will not be happy to buy at such a premium price. So whoever bought here is basically the final person willing to buy at these higher levels. Now, with less buyer interest, the market has to start to return to some kind of median, okay? It has to start pulling back because if you want to sell, well, you're gonna have to sell it here now, or here, or here, because there simply aren't the buyers willing to take at that exact time your orders for a higher price, right? So we don't wanna buy up here. If we're buying, we want to buy at more discount prices. We don't want to buy in a premium, which is why we start to see when markets get overextended, returns back to more fair levels, okay? Back to that kind of equilibrium. So marking the low to the high of this movement, we have the 100% retracement, the 50% retracement, and the 0% retracement indicating the exact high of the move. If we wanted to buy, we could first of all take a look again at the demand. So we have a demand zone here. This is realistically the most premium price in this bit of movement, but it's not the most premium price overall. We've also got a demand here that could be used. And then there's a big run down. There's a demand here, and there's one all the way down here as well, which is still imbalanced at the very extreme of the discounted price range. So of course, from what we've just discussed, anything over the 50% mark is not something we want to look at buying, because again, if you're a large participant, you want to buy hundreds of millions of dollars or tens of millions of dollars worth of dollars, you're not going to do it up here. You want to do it at the most discounted price so that you have the best price for the assets you've bought. Then if the exchange rate shifts positively again, you're profiting because your dollars are appreciating against other assets, okay? So looking from the lens of the institutions, we don't want to buy there. We don't want to buy the second point. We ideally want to buy at the most premium price point. And we can buy from here if we are told to do so via confirmational shift, because both of these points are in the discount, okay? So when we start to trade it into the discounted price range, we come down, we break through this level, which indicates to us we don't want to focus on this one, and we should instead focus on buying from the most discount price possible. Now, this market naturally flows down for the same reasons, but flips in reverse. We have less willing buyers up here, and sellers now are trying to get out of positions, so they are selling to the buyers at lower prices. As people buy up at lower and lower prices progressively, the market naturally flows down until eventually we reach a point where that control shifts. Sellers no longer want to sell at a price this discounted, but buyers are now happy to buy at a price this discounted because they're getting a great deal on the asset. So with sellers being unwilling to let go of what they're holding down here and buyers being more willing to start buying the asset again, we see that flip. Okay, there is less supply entering the market and more demand entering the market. Sellers want a more premium price, so do buyers at this point if they're buying down here, and later buyers just want to get in before it goes any higher. Okay, so this is the injection of essentially a lot of buy-side liquidity, a lot of buy-side pressure going into the market, which creates these upward pushes and actually flips us once again to trading back into more premium prices. All right, so it's just all a battle between buying and selling. Today's class, buyers always want a discount price. Sellers always want a premium price. And what we want to do is follow the mind of the large players to execute from premiums or discounts, okay? In an upward move, we should not be buying in premiums. And in downward moves, we should not be selling in discounts. We want to make sure we're getting the best deal possible so that we can get the best price and therefore the biggest possibility for profit, okay? If we're selling at the most premium price possible, we have all of the range to run through until buyers start to be interested again. If we are buying at the biggest discount, we have a significant positioning ahead of additional buyers coming in until we start to reach premium prices where people start to offload positions and rebalance that market. It gives us the most possible room to move from our execution to our target with the best risk reward and the best profit potential. So in order to utilize premium and discount theory in the most simplistic way, use that Fibonacci retracement tool. Never buy above the 50% mark and never sell below the 50% mark. Allow it to return to the premium range for sales, which is always the top 50%, and allow it to return to the discount range for buys, which is always the bottom 50%, okay? And if you do this, you will avoid getting caught in trades where you are buying too expensive or selling too cheap, and you'll be getting the best possible executions on pretty much all of the trades that you take. So that is premium and discount theory. Hopefully that's been valuable. Hit the link in the description to watch the trading diagnosis class to help you with everything that you don't see on the charts that's holding you back. And I will see you in the next episode of the Bootcamp.